So I think the major gold stocks could easily double in this up leg, and they're nowhere close yet. In the mid tiers and juniors, they could triple, some could quadruple because there's so low interest in them, and their market capitalizations are so low that if anybody starts buying at all, these stocks just launch vertical. It's such a small sector, Andy, as you know. There's so little room for capital, so little room for new buyers, and so I'm super bullish on the juniors and mid tiers.
Adam Hamilton, how are you?
Great, Andy. How are you doing today?
I'm doing great. It's really good to be with you. And as I mentioned offline here, you're one of the guys that started it all with me, especially with I love your view on both technical analysis, marrying that with the fundamentals. And not a whole lot of people do that. It tends to be you're one or the other, but you're both. So I really like that. Let's start out with I really want to dive into just really what's moving the gold market. It's been on the tear really since I would say last October, November, but more recently since the maybe in February. What's your thoughts? And I hate to use the word feel, but I'll use it. It just feels different this time. So what's going on?
Oh, Andy, it sure does. It's been really exciting. I've been doing this for almost a quarter century now, which is crazy. It's going on my 25th year here. It does feel different. It feels very, very dissimilar from anything I can remember in that quarter century span. You're right. Gold bottomed in early October, about 1820. It started rallying then. It happened to start rally right before the Hamas attack in Israel, but the Hamas attack in Israel kind of supercharged that V bounce. And then it shot up into early September, hit its first new record high, or early December, excuse me, first new record high in early December in 3.3 years. 2050 was kind of a ceiling for it for a few years. After that, gold consolidated high from December to late February, early March. Then the first trading day of March, that's when it really started taking off. That's when it really started feeling different and awesome. There was a Fed governor, and he gave a speech. And these Fed guys talk all the time. As you know, they call it Fed speak in the markets. But he talked about possibly adding more short-term treasuries to the Fed's balance sheet. I don't think he was talking about new money printing specifically, but traders kind of thought it might be more quantitative easing. I think he was talking about shifting long-term treasuries into short-term treasuries. But anyway, the hint of more QE just launched gold like 2.5% that day, and it just hasn't looked back since. And so yeah, since early March, it's just broken out this incredible, remarkable breakout surge. And I call it remarkable, not loosely, Andy. My approach to the markets has been I like to figure out what drives the markets and why. I'm a speculator. I'm a trader. I actively trade gold stocks. I have for decades. And so I just want to figure out what's moving gold and why. And that's my focus. And generally, major gold uplegs have three stages. There's the first stage is gold futures short covering. Speculators trade leverage gold futures. They have a huge outsized impact on the gold price, up to 25 times the capital they deploy because of the leverage inherent in futures. We had that short covering spree back in mid-October and maybe into early November. The second stage is speculator gold futures long buying. There's a lot more guys that trade long side gold futures than short side ones. The third stage is gold investment buying. And the thing remarkable about gold's rally since early March is these three primary drivers that have worked for gold for 15 plus years, they don't explain it anymore. Everything that's happened since early March, Andy, it's not gold futures speculators doing the buying. It's not investors, at least not American stock investors, the normal drivers. So it's really been remarkable.
That is a huge point, and dare I say, fact. So that begs the question. I hope I use that right. Who's buying? What's moving it?
For all of Q1, all the gold guys, the analysts, the speculators, the investors were wondering that, what the heck's going on here? It's not American stock investors. Their buying is evident in the holdings of the two giant gold ETFs, GLD and IAU. Those comprise about 4/10 of all the physical gold holdings held by all the world's physically backed gold ETFs, according to the World Gold Council. People were guessing it was Chinese buying and central bank buying all throughout Q1, Andy. And that was my guess as well. Chinese demand is kind of opaque. Chinese government publishes some data, but you never know. The Chinese central bank, the People's Bank of China, they've been buying gold, but for years they say they buy no gold, and then all of a sudden their holdings jump up radically. So they report erratically, and they probably hold way more gold than they reported. But like Bloomberg had run stories about consumer demand out of China during Q1. Like in China, they sell physical gold down to like single gram quantities, 1/32 of an ounce. and they called them beans. And I saw many stories in Wall Street Journal, Bloomberg about like even young Chinese like investing in these physical gold beans, these 1 gram round physical gold items, objects. And, in China, there's been lots of problems with the economy. Of course, there's a real estate bust after a bubble that happened. So residential real estate's a terrible place to put your money in China. There's been a bear market in stocks in China since, I don't know, for the better part of 3 years here. And the major US ETF that tracks mid-size and large cap Chinese stocks, that was down almost 2/3 in that span. So the Chinese stock market's been horrible. China's government won't let its people move money offshore. They're trying to crack down on cryptos as well. So gold was just a logical place for Chinese to go. And Andy, this all got confirmed just last week when the World Gold Council published its latest gold demand trends report. These come out once a quarter, and they're absolutely fantastic. I highly recommend all your readers, all your listeners, check them out. They're free, they're amazing, they're deep, they're well written. But they're the best available data on global gold supply and demand. And the Q1 version just came out again, and it shows that indeed it was Chinese buying and central bank buying that drove this huge gold surge from the tail, certainly in the tail end of Q1, probably all Q1 really. Chinese bar and coin demand per that report was up like 67% year over year compared to Q1 23. And Chinese jewelry demand was high, and both those comprised about a third to 4/10 of total global demand in those categories. American bar and coin demand, for comparison, was down 44% in Q1. Americans couldn't care less about gold right now because the stock markets are high in a bubble. Central bank gold demand per that latest WGC GDT, that was kind of flat from Q1 23, but it was still double like the 10-year average before that. So central bank demand's been high. Chinese demand has been amazing, and that's what's been driving this gold breakout. Not Americans, not gold futures traders. That's what makes it absolutely remarkable. Just absolutely fascinating too.
It is. It's really interesting, and I guess it's almost, I wanna use the right word, it's almost scary in the sense because and what I mean by that is, like, scary exciting is it
Yeah.
the best way. Um, because this is not acting like it's ever has been, and you set it up great because where is the Americans where is the West buying? I mean, I just don't see it. It's coming from the East, and that's that's interesting and that's exciting. And then when I'm rambling here, but I would say that's scary because it's like gold is flowing from our shore to them, and good for them, right? But not so good for us.
Yeah,
So
scary exciting is a great way to describe that, Andy. I agree with you 100%. Yeah, geopolitically, the gold flowing to the east is concerning, but from a speculation, from a pure trading standpoint, this is crazy exciting indeed because the Western investors and speculators, they chase momentum. We see that in the stock markets all the time. You have a hot stock, even amongst the Meg 7 mega cap techs, there's always one or two that are really hot at the time. There's a couple lagging. Like Apple and Tesla aren't doing great right now. Nvidia did amazing through the AI bubble. But gold is going to be like that too. People are going to see it rise. They're going to see the increased coverage in financial media, which is really started to spin up and is really bullish. And as people see gold price rise, they're going to start chasing it. So we've had virtually zero Western investment demand through this whole up leg for years, actually. And then the Western investors are going to come in and pile on top of the Asian buying. And so this gold up leg got really overbought back in mid-March. It was stretched about 19% above its 200-day moving average. Generally, when gold gets 15% plus above its 200-day moving average, a correction's coming, a sell-off to rebalance sentiment. The last time gold was that high, 19% above its 200 EMA, was back in August 2020 during a major secular top that wasn't exceeded until December 2023. But this time around, it's different and remarkable and unusual, and it feels different, as you said, because if Western buyers haven't come in yet, gold can go way, way, way higher than if they'd already spent most of their probable buying. And I just think that's incredibly exciting. This up leg has a long way to run just because Western investors haven't participated yet. One more thing about that, Andy, before we move on. The GLD plus IEU holdings, those giant American gold ETFs, again, they're the best proxy. They were the best proxy for global gold investment demand for over a decade. And they are the best proxy for American investor demand. They're sitting just like 1% above 5.4-year secular lows right now, which were achieved or which were hit in March. And so there's zero. American stock investors couldn't care less about gold. European investors are kind of like that as well. It's just absolutely remarkable. They haven't come in yet and pushed gold higher, and they're going to pile on top of this Asian buying and chase this momentum. It's going to just be magnificent.
I love that you said that because it really shows just the sentiment in the West, in America here, and that's what you want as a speculator. You see, you want something so out of favor, and it's one of those things that is just hitting. It's hitting for us really well, and we have this strong market that nobody cares about, and that's what you want. And all the fundamentals speak to that. Speaking of which, you talked about some of the technicals. You talked about moving averages, and throughout your work, what are the moving averages? You mentioned the 50-day moving average, and then again, just walk me through that again. Where are we at as far as moving averages, and what are other technical indicators telling you about the current gold cycle or market?
Fantastic question. Again, my focus is what's moving markets and why. I'm an active trader. My newsletter subscribers are active traders. So we want to know when things are going to rally, and we want to have a high probability for success of buying. And so the moving averages are really interesting, Andy, because sentiment moves markets, herd greed and fear. When people get excited, they buy something, it goes up fast. When people get scared, they sell something, it goes down. When the selling or buying is mostly exhausted, it bottoms out, it tops out. But you can't measure sentiment, right? You can get an idea for it, but it's ethereal. It's not tangible. But moving averages are really interesting because they're baselines that aren't static. The problem with a static baseline for markets is that prices move. There's different prevailing gold levels now at $2,400 an ounce than there was a year ago or 10 years ago or 20 years ago. Um, my daughter was in here this morning before she went to school, and I have some gold coins in my desk here, and she hadn't noticed them before. She's like, "Dad, are those gold coins?" I'm like, "Yeah." And she's like, "How much are they worth?" I'm like, "Oh, $2,400 maybe." And she's like, "Wow, that's a lot of money." I'm like, "I bought them when they were $300 an ounce." And that just kind of blew her mind. But anyway, like the baseline moves. And so my favorite moving average to kind of see if markets are overbought or oversold, if they rallied too far too fast, if they sold off too far too fast to be sustainable, is a 200-day moving average. And I developed a trading system, I don't know, 15, 17 years ago, I call relativity, because it looks at price levels relative to their 200-day moving average. It's super simple. You just divide the gold price by its current 200 DMA, and you get a multiple. And the interesting thing, Andy, is you can chart those multiples over time, and they form horizontal trading ranges. And when a price moves too far away from its 200 DMA to the upside or downside, odds are that move is about done. If it's the downside, you can buy, you can pile in. If it's the upside, you should probably ratchet up your stops, prepare to sell. Now, you mentioned the 50 DMA. That's a really important one as well. The 50-day moving average is the highest probability support zone for ongoing up legs. So gold got really overbought in mid-March. We talked about a little bit earlier, and it probably should pull back a bit or at least consolidate high until it hits its 50-day moving average. And that was around 2,200 back in mid-March. It's a little bit higher now, maybe 2,250. Gold's been kind of grinding sideways for a month now, still doing awesome. But I like the moving averages because they're non-static baselines that show how far prices have stretched from norms. And the farther they've stretched from norms, the higher the probability of successful buy or sell on a trade. So yeah, that's all there is to that. Just trying to infer sentiment based on how violently prices have moved.
Let's talk some stocks here, gold stocks. So what's confusing to me, and I think for most traders or investors, or which is one and the same, it just depends on your timeline in my mind. But why haven't the gold stocks, especially the juniors, moved? What's your theory on that?
I think we touched on this earlier, Andy. It's back around to American investors just don't care. The S&P 500, the main U.S. stock index, that's just been shooting vertical at least until the end of Q1. It topped out at the end of March. But people are really enamored with this AI-driven stock market bubble. They love the mega cap techs. Gold investors are so discouraged, gold and gold stock investors, because gold ground sideways from 2020 to late 2023. And so they're just not, there's just sentiment in gold is so bad. Sentiment in gold stocks is way worse. People have been distracted because of the stock market bubble, the Meg 7 stocks, the AI thing, NVIDIA, just went stratospheric this year. They've been distracted by Bitcoin. Some, especially younger people call it digital gold. I would kind of disagree with that characterization, but Bitcoin's really interesting nevertheless. And so people only have so much mental bandwidth to devote to speculative assets. And there were things moving up faster than gold. And gold's really only been rallying since early March, as we discussed earlier, only been surging since early March, that remarkable breakout surge we talked that the Chinese and central banks are driving. So I just think gold hasn't rallied long enough yet and hasn't won enough interest yet for the gold stocks to get bid. Really the only reason to buy gold stocks is because their leverage plays in gold. Their profits amplify gold price moves and their stock prices do as well. And so if you don't think gold is going to rally or don't think gold is rallying, then there's really no reason to own gold stocks. So gold stocks tend to lag gold, especially when people aren't interested. So I don't think it's a big deal. And I think people will come around as they start seeing gold and understanding how powerful its rally is and how unusual it is. There's just not enough interest yet, but it's building. I can tell that through our newsletter sales, the emails I get, the people I talk with. There's all kinds of anecdotal stories about people getting more interested in gold stocks. So interest is building. It's just not here yet with those distractions we had in recent months.
Yeah, my mother is interested, which
Great.
is like, yeah, it is great. When he's 80 years old and he lives in Washington, and I was just chatting with her the other day, and she made a bunch of money in gold and silver just the last, well, it was about 2010. And then she's like, "Hey, how's gold doing, Andy? Thinking about getting back into gold and some gold stocks and, selling my, whatever it was, it's her
Good
belief
for her.
So I was like,
That
yeah,
just
it was
goes to
fun.
show that people
Yeah,
see it on the media. They see these reports, new record highs, and they gradually start to warm to an asset that they've forgotten about for a long time. And that's absolutely happening, as your mother illustrates beautifully.
right. So what are your indicators talking about, the gold stocks? Where are we at? Yeah, where are we at with all that? And then I also want you to comment on the seasonality. You also sent me on the seasonality. This was years ago, and I know we're going to, or we are coming out of a good season and then going into the summer lull. Does that still work? Um, with gold as high as it is? Does that all make sense?
Yeah, it makes perfect sense. The problem with seasonality is it's a tertiary driver of prices. The
Mhm.
main things are sentiment, technicals, and fundamentals. So I'd rank seasonality as a distant fourth, Andy. And so seasonals kind of act as tailwinds or headwinds. And so we are in a seasonally strong period for gold and especially gold stocks. May is one of the strongest months of the year for gold stocks. That runs into early June, like the first week in June. Then June's week, just kind of the summer doldrums thing. And then early July, the gold and gold stock buying picks up again. Yes, you're right. Because gold is advanced so far, the odds of further seasonal advances are lower. But on the other hand, seasonals are a tailwind. If the Chinese keep buying and Americans start getting interested in gold and start bidding it higher, the seasonals will certainly help that. Um, you know, Gold stocks, again, it really depends on interest. The seasonals will help them, but people need to get interested in gold stocks, and they are, but it's a slow process. And so, yeah. And your first question on technical indicators, could you elaborate on that one again, please?
Yeah, I guess where are we at in regards to the moving averages, both the GDX and then then some of the juniors, if you would, just as a collection. Where are we at as far, yeah, with your indicators that you use?
Yeah, gold is really overbought in mid-March, but it's ground sideways. It pulled back about 4.2% as of a week or two ago, but it's mostly ground sideways, which is fantastic. There's two ways to work off overbought conditions. Number one is a sell-off. That's pretty
Oh, it
short
does
and
slightly.
fast. Number two is a consolidation, high consolidation. It takes longer, but it still bleeds away excess greed. They're both fine.
They're
High
both
consolidation is less painful for people. It just takes longer. And so, yeah, gold's looking good. It's probably 14% above its 200-day moving average right now, which is way better than 19% back in mid-March when it was looking, extremely overbought. Gold stocks aren't overbought at all. I mean, they're just nothing. Every Friday, I publish a new web essay on our website. I think last week I wrote an essay on gold's pullback and gold stocks pullback. If your viewers are interested, and it has these charts of these relative trading ranges of both gold and GDX, the major gold stock ETF. And
yeah.
GDX was nowhere near overbought, Andy. Nowhere close. Yeah, gold was overbought, so gold can pull back or consolidate high, but gold stocks don't need to. You also touched on where are they going. Gold's up leg so far is up 31% at best.
Mhm.
And this up leg is really interesting because it's an up leg that's achieving new record high streaks. And new record high streaks really drive financial media coverage, which gets people interested in gold. So more capital flows in, which makes for bigger up legs, bigger rallies. The last two gold up legs that had new record high streaks both crested in 2020. The first one before the pandemic lockdown stock panic, the second one after it. One was like 42, 43% gains. One was 40% gains in gold. And I call those monster gold up legs. They're really big, but this one isn't even at monster status yet. And again, Americans haven't started buying, so it could grow way bigger than that. The reason this is interesting to me is because GDX, the major gold stocks, GDX is big gold stocks. GDXJ has mid tiers and a few juniors, but GDX more than doubled on average. Like I think average 105% gains during those last two monster gold up legs that achieved new record high streaks. So I think the major gold stocks could easily double in this up leg, and they're nowhere close yet. In the mid tiers and juniors, they could triple, some could quadruple because there's so low interest in them, and their market capitalizations are so low that if anybody starts buying at all, these stocks just launch vertical. It's such a small sector, Andy, as you know. There's so little room for capital, so little room for new buyers. And so I'm super bullish on the juniors and mid tiers. I don't look at technicals on GDXJ per se very much, but in general, in the past, the longer gold stocks rally, the major gold stocks, the more capital starts flowing into juniors and mid tiers, because that's when people start to believe. First, they got to see gold rally and believe it's for real. Then they got to see the major gold stocks rally and believe it's for real. Then they start buying the mid tiers and juniors, and their gains just they come from behind. They shoot up parabolic and just far surpass the majors, since they have superior fundamentals, the juniors and mid tiers. They're much smaller market caps. So yeah, the outlook's really good regardless of seasonals.
Got it. Okay. And then lastly, what I want to get hit on, and this is a question that I get all the time, and one that I'm also concerned about, is you mentioned a stock market bubble, which I agree with. Let's say that pops, and let's say, how does that affect gold stocks is what I'm trying to get at, because gold stocks are stocks, right?
Yeah, it's a fantastic question. So basically, gold stocks can get sucked into major stock market sell-off. The sharper the sell-off in the SPX, the SP 500, the more gold stocks can get sucked in, the more they fall in it. That March 2020 pandemic lockdown stock panic was a key example. Gold stocks just plummeted in that thing. I mean, I think the SP 500 fell by like a third in 21 trading days, and gold stocks exceeded that, even though there was no reason for them to sell off. So I would define sell-offs kind of using in classic definitions. A crash is a 20% S&P 500 drop within 2 trading days. A panic is 20% plus within 2 weeks. And a normal bear market is over a much longer span. And while we're in a bubble, Andy, for sure, the average trailing 12-month price to earnings ratio of the SP 500 stocks is running like 31 times earnings. Bubble is 28 times.
Yeah.
Historical fair value is 14 times, half that.
Right.
I think we're in for a bear, and bears tend to last 2 years or so. So if you think of a 20% to 50% decline, which is 50% is a major stock bear, 20% is minor, somewhere between there, the stock market should fall over the next couple of years. It's a really gradual sell-off. And the purpose of bear markets is to keep people fully invested in markets as long as possible, right? So they're kind of deceptive. It's kind of boiling the frog slowly, turning up the heat slowly, so he doesn't know it's being boiled. So bear markets generally don't have crazy sharp sell-offs like panics and crashes do. And the gold stocks will be absolutely fine in a normal stock bear. They'll absolutely thrive. Occasionally, we'll have a big down day in the SPX, and that will suck in gold stocks. Generally, gold stocks tend to split the difference between what gold does and what the SPX does. So say gold's up 1% on a day and the SPX is down 3%. Gold stocks might be down like 1.5%, 2%. But as long as we don't have a panic or crash scenario, gold stocks will do great. If we do have a panic or crash scenario, then they'll have a bad week or two, but after that, they'll rebound strongly and gold will just catch a huge bid. So I'm not too worried about the effect of stock market selling on gold stocks based on all my studies of history. It's definitely worth worrying about. It's a legitimate concern. It can happen, but the odds are fairly low for that sharp a sell from the SP 500.
That's probably the best answer I've ever heard. I really mean that. Because I remember trading in 2007 and then 2020, everything went down. But if you look at, because that was just a tank and everything, if you would. But if you look at 2000, when the stock market sold off, if you would, with this bursting of the NASDAQ bubble, gold stocks did remarkably well. Correct me if I'm wrong.
No, you're absolutely right. Yep.
Yeah.
And generally, the longer the span, if you look at a whole stock bear span, gold and gold stocks do great. You can pick an isolated week or 2 or 3 here where they get sucked into the sharp stock selling, where they get hit. But overall, through the entire stock bear span, the gold stocks have generally done fantastic, actually. They're the best sector to own that I've found during stock bears, which is really encouraging.
That is encouraging. What final advice would you give to the listeners? What final investment? I mean, I don't want to say investment advice, but just advice in going into this, what we believe in early stages of a bull market, would you give?
One proxy for American investors' gold allocation, Andy, is to take the total value of GLD plus IU physical gold bullion holdings and divide them by the S&P 500 stocks total market capitalization. That's running under 0.2%. So most people have effectively zero gold allocations, nothing in gold. And with stock markets inarguably in a bubble, we're due for a major secular bear in stock markets, and gold is still relatively low. If you look at inflation adjusted terms, despite being $2,400 an ounce, it could go radically higher. You look at all the money supply growth in the past, 20, 30 years around the world. I just would encourage people to think about allocating some reasonable percent of their financial portfolios to gold. Historically, people advise 5% to 10% for centuries. I think that's really prudent. I think everybody needs a gold stock allocation as well. You know, that could be an additional 5% to 10% of your portfolio. But people are just, even people with retirement accounts are just heavily overweight the Meg 7 market darling tech stocks. And those
Right.
don't do well in bear markets. There was a minor bear, 25% in 2022, January to October 2022, and the S&P fell 25% ish, but the Meg 7 averaged 54.6% declines right around that span. It wasn't during the exact bear. They all had slightly different bears, but they more than doubled the stock market decline. So I just encourage your listeners to, get some gold, whether it's gold ETFs, physical gold bullion to hold your own hands, great gold stocks with superior fundamentals. Everybody needs allocations of gold in their portfolio. Don't go crazy. Don't have to have 100% gold or gold stocks, but start at 5% or 10%. It'll really protect you in this bear that's coming.
Excellent. Adam, if people want to get in contact with you, how do they do that?
We have a website, Zeal, LLC.com. Everybody's welcome to come there. I publish a free essay every Friday. We publish a couple of paid subscription newsletters as well to pay the bills. Yeah, we stop by. I'd love to see you. So thank you so much, Andy. Really appreciate it.
The pleasure is all mine. And yes, it is excellent. I will put all of this in the show notes below, as well as in the podcast. Thank you so much, Adam.
Thanks for having me, Andy. Great chatting with you today.
It was awesome. Thank you. Bye.